Welcome to the Return on Lifestyle podcast with Rey Descalso from Pravada Wealth Management. In this podcast, we help you overcome financial worries and make sense of planning, investing, insurance, and banking. Join us for this journey as Rey draws from his expertise and interviews brilliant minds to help you enjoy life. The best is yet to come.
Hi, and welcome to Return on Lifestyle with your host, me, Rey Descalso. You may notice there's some changes here today. What we're doing is we are taking the production of this podcast in-house, and the reason we're doing that is because we want to be able to provide you more timely updates and be able to do a couple different things. First off, sometimes there are things that we have to get them out, and so in the past we would always have a podcast coming out about every 2 weeks. But what happens when there is a yield curve inversion or major news, and we want to get the word out quickly? Having the podcast in-house makes a lot of sense. Also, one thing you may realize if you're on YouTube, we now have video. So you can keep listening to this podcast via Apple or Google or however you listen to podcasts. But you can also go to YouTube and subscribe if you'd like to see our faces. And we'll add some Easter eggs. So sometimes we'll have a list and we'll be able to provide, in this space here on the video, bullet points for the list and that kind of thing. So it's a nice little upgrade. So that's exciting. Also, we're able to have guests, and you can see here today, I'm joined by my colleague and sometimes co-host, Rey Coffin, and it'll give us this opportunity to see people face-to-face, interview some folks, because this is about investing, it's about retirement, but it's also about return on lifestyle. In other words, experiencing your very best lifestyle. So we plan on having some guests here in my office, which is also our studio, and to learn more. Before I go any further, though, I want to remind you and reintroduce you to Rey Coffin. Jared was on a podcast earlier, so go back and listen to that one if you want to hear his life story and all of his thought processes about investing and so forth. But also, too, I want to get a quick update from you. Good morning, Jared. Welcome.
Thank you.
So Jared is currently, I should say, he is studying for his CMT certification. Jared, what is CMT and why are you doing this?
It stands for Chartered Market Technician, and I like the technical aspect of investing, and I guess I like the pain of studying.
Yeah. So it's an analyst designation, and
Correct.
You're working on that, and it's in 3 parts. How far have you gotten in the process?
So I'm gonna sit for level 3, December 12th. So completed 2, got the last level. Hopefully, fingers crossed, pass it. And
Very cool. And how many CMTs are there in the world? Generally speaking, we won't hold you to it if you're off by 1 or 2.
That's a good question. I don't know the answer to it. I know there's not a ton, but the information that's out there, I would have to check on the CMT Association and get back with you on the numbers.
I think there's more CFAs than there are CMTs.
Definitely.
Okay. Interesting. Well, good luck with that and keep us updated. Hope to hear back from you on your great success. Today, we're going to be talking about ETFs. And one of the reasons why we're going to talk about ETFs is because we do a workshop called Taxes in Retirement from time to time here locally in the Central Florida area. It's a great workshop. We have a lot of fun with it, believe it or not, even though it's about taxes. But what's interesting about this Taxes in Retirement is one of the things I recommend is if you have a non-qualified account, I recommend that you don't put your money necessarily in mutual funds, but you put them into ETFs because exchange-traded funds, which is what ETF stands for, are more tax efficient. And I think Jared can concur, when we're there, I get about a third of the audience has sort of a deer in the headlights look. And then somebody oftentimes will raise their hand and say, well, what's an ETF? And, that's a fair question. Being nerds in the business of retirement, we know what ETFs are, but a lot of folks don't. So today I'd like to cover what ETFs are. I'd like to go through some of the high points of why they are gaining steam and why they're becoming more and more popular, and also some of the places where they're weak or where you don't find ETFs available to you. So first off, let's talk about ETFs, what they are. Well, let's talk about the origin story. ETFs were born in 1990 in Canada. I had to Google this. I did not know that. I just assumed they were from America, you know.
I had no idea.
Yeah, interesting what you learned today on Return on Lifestyle podcast. They're from Canada, which it almost offends my capitalist sensibilities, but okay, we'll put that aside. They're good in every other way. ETFs are good, except for that they're Canadian. If we have any Canadian listeners, my apologies. That was a joke. I hope I didn't trigger you. Now, the thing about ETFs is they're like mutual funds. In fact, the way I say it on the blog, there's a blog on my website, Pravada Wealth /blog, and you can read some of Jared's blogs there. You read some of my blogs there, but you'll get a lot more details from the blog in terms of some of the data. So take a look at that, and I'll be cheating off of my notes from my blog right here because I'll have some data I don't quite have memorized. But the way I explain an ETF is if a stock and a mutual fund had a baby, okay? And so an ETF is a basket of stocks. It's a stock. An ETF is a stock, or I should say it trades like a stock, because what it is a fund that is a basket of stocks. And what's nice about it is you put that index together, let's say the S&P 500 index, it has all 500 stocks there as a basket. And what's interesting is like a mutual fund, you've got instant diversification. You buy this one ETF and you have the S&P 500 or whatever, index or whatever strategy or whatever theme we're talking about. So it could be only high dividend stocks, it could be a bond ETF, but it trades like a stock. Why is that significant? Because a mutual fund is different in that it is traded only once a day. With a mutual fund, it is a bunch of stocks, but it has been purchased by the manager, and it can only be traded and priced at the end of the day. And that's kind of significant because, as we're going to find out, that there's some efficiencies that an ETF has that a mutual fund doesn't have. So that's what an ETF, that's where it comes from. That's what an ETF is. It is a fund of stocks that trades like a stock. Okay, good. So now the question would be, well, what's the big deal? Well, one of the big deals is how fast ETFs are gaining steam. In other words, in 1924, the first mutual fund was invented, and still lots and lots of money is in mutual funds. But ETFs are gaining steam, and more assets are flowing towards exchange-traded funds over and above mutual funds. Why would that be? And check out the blog for the exact numbers. Well, there's a couple reasons why this for this popularity. Okay, number one, the popularity is, as I already mentioned before, and as I mentioned in our workshops, is tax efficiency. And so what ends up happening is if I want to sell a mutual fund, right? I call Jared up and say, "Hey, Jared, I want to sell my mutual fund. Go ahead and give me my money back." Well, if Jared is the mutual fund manager, what he has to do is he has to create cash. And so he has all of these stocks, okay? And then he gets the order that Ray wants his money back, and he starts selling all these stocks off. Well, some of these stocks are sold at a gain. Some of these stocks are sold at a loss, right? The problem is that now the the mutual fund that has sold now could have a capital gain reported because of the fact that Jared had to sell the stocks to create money for me, the shareholder. So now I have my $100, and the mutual fund has created a capital gain, and I'm going to get capital gain notice at the end as a client at the end of the year. Well, the problem is what about you who didn't sell the mutual fund? You didn't do anything, okay? You were just sitting there, and 2018, the mutual fund lost 6% on paper, right? You still have it. And then you get that same notice about March and says, "Hey, you owe taxes on this mutual fund that you never sold, right? And you didn't do anything, but you owe taxes on it." Those are we call them phantom gains. They're phantom because you never had those gains. I'm getting a phone call here. Very, very popular. You didn't have those gains, but you still are on the hook for the taxes. And that's one of the problems with mutual funds. Now, the beauty of an ETF is this. With an ETF, if I want to get rid of my ETF, what do? Well, I have ETF, and let's just say it's the S&P 500. Doesn't matter which one. I want to get out. So what I do is I take my $100 worth of ETF shares and I sell it to Jared. Now, Jared's not a manager. He's just a person. When I sell it from me to him, that's how I got rid of it. There was no redeeming inside the ETF. The ETF didn't do anything. It just went from my hands to his hands. Now, if I have a profit, I pay the taxes. But other people like yourself who own the ETF, you're not on the hook for the taxes. That seems fair. And so take a look at your statements. Take a look at your statements and say to yourself, okay, I have this non-qualified account, and in it I have mutual funds. And those mutual funds are oftentimes active mutual funds. And if they're active mutual funds, there is a chance that you're going to find yourself, actively managed mutual funds, you're going to find yourself with a tax bill through no fault of your own. And so there really is no comparison. ETFs are far and away more tax efficient. So consider that. That's number one reason I think that we're seeing a big surge in ETFs and their popularity is because of the tax efficiency. But there's more than just that, and that is expense. So if you go to an actively traded mutual fund, you're going to find yourself paying a fee. This management fee can range from anywhere from 0.5% to, if it's an international emerging growth fund, it can be high as 1.6. I haven't done a recent search, but I've seen funds with 1.5, 1.6% fees inside that mutual fund. And why is that? Well, because the manager has to go fly to Japan or India and investigate the stock and make sure it's good. And also, too, there's trading costs. And the people who are managing it and doing the job of picking the very best stocks, well, they got to get paid for their hard work, right? So an ETF is typically static. It typically is an index. And because of that, their fees are anywhere from what would you say is a fee, an average fee for an ETF, an index-based ETF?
Very low, normally anywhere from like about 5 to 9 basis points.
So 5 to 9 basis points.
Yeah.
So, I would say that the mutual funds could be anywhere from 50, 65 basis points all the way up to 160 basis points. So that's 0.5 to 1.6. And what I hear you saying, Jared, is it can be 0.08 to 0.2. Very low. And it really is important to look at that, because the fees that you're paying, all things being equal, if both go up 10%, an ETF and an active mutual fund, obviously if they both go up 10%, well, not including the fees, I would rather pay less fees than more fees.
Yep.
All things being considered. Well, then there's also one other thing, and this is kind of a shift in our industry. What we're realizing is that most active mutual funds don't beat their index benchmarks. Okay, so let me unpack that. Okay, so the number that's bandied about is that 80% of active mutual funds don't beat let's say the S&P 500. So if I'm a mutual fund manager, typically I have a mandate and I have a benchmark. The mandate is make money, okay, in this particular sector or this particular theme. And so if that's the case, then I have a benchmark, and that benchmark is my competition. I want to beat my benchmark. And if I beat my benchmark, then I know that I'm a really smart person. I probably should have taken my phone off before we started this.
Just pick it up. It'll make it interesting.
Exactly. That was my wife. She says hi to everybody on the podcast, by the way. So what ends up happening then is you have a benchmark as a manager. The problem is a lot of these guys aren't beating their benchmark. They're not doing much better than the S&P 500. And what's even more of a pain is we don't know this year who's going to beat their benchmark next year. It's not always the same active person doing it. And so I guess you could say that many people in our industry have kind of waved the white flag and said, it's better for us to choose the correct indexes for our clients and their asset allocation than necessarily to try to figure out who's that best manager. And so if that's the case, a lot of folks are getting away from active management and moving more towards index ETFs and index mutual funds. And so does that a fair estimation? I think I've explained it okay?
Yeah.
Okay.
And the ETFs also have active ETFs as well. So you still have that, which I'm sure you're going to say, you still have that option.
That's the other thing that's kind of crazy is, when it comes to passive indexes, like a thematic investment, there are every day there's a new ETF coming out.
Yeah.
They'll have an ETF that's the S&P 500, an ETF that's the Russell 2000, an ETF that's small, mid cap, large cap, bond ETFs.
Momentum, value,
exactly.
Low volatility. There's just a million of them.
It is 6 ways to Sunday.
Yep.
Is basically the way ETFs are structured now. So if you want to get creative and you want to say, okay, I'm going to have 80% of my portfolio kind of just boring, and it's going to be that typical pie chart with inexpensive passive, meaning they don't change, they just follow an index, like they follow a benchmark. That's great, but we can also say, hey, here's a really cool idea. And these really cool ideas typically, and you heard the nerd over here with studying for the CMT talking, they're typically things like momentum and relative strength and low volatility, and this can add some spice, if you will, to your portfolio. You can have a core portfolio and a satellite portfolio. And what's crazy is that these active ETFs, they're not that expensive compared to their big brother mutual funds, who are doing something very similar as far as strategy goes. And so ETFs are providing us with just a whole brand new world. And every single day, ETFs are gaining ground. And by gaining ground, I mean not necessarily they're performing better, but they're gaining more assets. More people in the retail space, people who listen to podcasts like this, are saying, hey, I think what I'd like to do is I'd like to invest in ETFs versus mutual funds. And we've even seen that in our practice as more and more ETFs become available and more ETFs make sense for clients. We have been seeing ourselves moving more towards ETFs whenever we can. So the question then would be, well, why not just do everything in an ETF? Well, a couple different things. First of all, if you've got a 401k, there are very few 401ks that allow for ETFs. Okay, so I mean, whenever you look at a 401k, your options that you have on that menu, almost always mutual funds. Now the question would be, why is that? Well, mutual funds have been around since 1924. And 401ks, I want to say a 401k started in the late 70s, early 80s. I'll have to look that up.
Oh, really?
Yeah, they've been around for a while. I could be wrong about that. But it may be in the 80s. But with that, that was what was available at the time. Okay, and it's much easier to administer as a 401k person, a security that's only traded every day. So back in the olden days of the 80s and 90s, mutual funds were all there really were, and it wasn't really that big of a deal. There are 401k providers that provide ETFs as part of the options. They're rare. I think they're going to take over the world someday, and that would be very exciting. That being said, you're not going to see, so a lot of the assets held in 401ks, and there's a lot there, are mutual funds, and oftentimes active mutual funds, and sometimes passive index mutual funds as well. 529 plans. Most 529 plans are actually promoted by mutual fund companies. And so you're going to see that there's not a lot of ETF action there. And then let me think here what other things are. That's basically it. The 401ks and the 529 plans are where you'll see. And again, you can find ETF-based 529 plans and ETF-based 401ks. They're just rare because the people putting them out there to the retail investor typically are mutual fund companies themselves who are helping to promote that. So a couple things. Just to recap, ETFs are great because they've got the tax efficiency. And I hope I've explained that well. Read the blog if you'd like to go over that. The other thing is low cost. That low cost helps people feel like, hey, if I'm gonna make 10% somewhere, I'd rather make it for less. And then third, I think the rise of indexing, the rise of using an index for your portfolio versus an active manager. Well, if I'm going to use an index, an ETF is a great way to access an index. And so that's the third reason that ETFs have grown. So the question I have to ask you is, are ETFs right for you? Well, look, that depends. I don't know you. I can't see. You can see me. I can't see you. This is a podcast. So what I'd recommend you do is I'd recommend you give us a call, send us an email, and we're more than happy to take a look at your portfolio and see if it makes sense for a portion or all of your portfolio to be in an ETF situation. And of course, if you find yourself already with lots of capital gains inside a mutual fund, well, then it may be something that we have to talk about strategically when it comes to taxes. Oftentimes, taxes are the tail that wags the dog. But one thing that Jared and I have talked about is don't let that happen. In other words, if your goals have changed, if your risk tolerance has changed, and it's time for you to say get out of a risky situation and get rid of some of your bond portfolio and get out of your equities and go into bonds or some sort of strategy like that. A lot of times people will say, wait, I don't want to pay taxes. We can talk about that. We have some software that we can take a look at what your tax projections are going to be and how much that capital gain is going to cost you. Also, if you've inherited some stock and you want to diversify, oftentimes holding on to that stock might be a good idea for the time being as we look at taxes. But again, don't let tax decisions cause you to be in a portfolio that isn't appropriate for you. I guess the point of the story, but give us a ring. We would be more than happy to help you make some of those decisions, give you a second opinion on what you already have if you don't already invest with us, and also take a look at the different types of investment options that are out there. If you'd like more information, simply reach out to us on our website at pravadawealth.com. There's a little Contact Us button, and we'd be happy to speak with you, answer some of your questions. Also, send us, if you'd like, some questions of things that you'd like us to cover here on this podcast, because we're hoping to do more and more and more for you. So, speaking for all of us here at Pravada Wealth Management, thank you so much for hanging out with us, and have a great day every day.
Thank you for listening to the Return on Lifestyle podcast. Click the subscribe button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Pravada Wealth Management. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider for any questions you may have regarding your investment planning. The following program is sponsored by Pravada Wealth Management, which is solely responsible for its content. Advisory services offered through J.W. Cole Advisors Incorporated. Securities offered through J.W. Cole Financial Incorporated. Member IFNRA, SIPC. Pravada Wealth Management is an unaffiliated entity from J.W. Cole Advisors and J.W. Cole Financial. The opinions expressed by Rey Descalso should not be construed as specific investment, legal, or tax advice. All economic and performance information is historical and not indicative of future results. Investing may involve the risk of loss of principal. Any tax advice on this show is not intended to be used by any person for the purpose of avoiding U.S. federal or state tax penalties that may be imposed on such person, and each listener should seek advice from their tax advisor or legal counsel on topics that arise from the show. Nothing should be construed as solicitation of an offer to buy securities. The preceding program is sponsored by Pravada Wealth Management, which is solely responsible for its content.